Vicky here. Today we'll talk about deferred tax according to IAS 12. This is one of the topics which is quite frankly tested in CR examination, ICW advanced level exams. So let's see exactly what it is. So deferred tax, simple and easy, is the timing difference between the profit you report in your accounts called accounting profit and the profit you pay tax on called taxable profits. So it's basically tax you'll pay later, which is going to create liability, or tax you'll save in the future, which will create an asset. Because accounting rules and tax rules don't always agree on when to recognize income or expenses. As you can see in here, I've put one example. So let's say, imagine you have got a business. Okay, sometimes the rules for how much profits you actually make is actually different from the rules for how much profits the government thinks you have for taxes. This difference can create sometimes called deferred tax. So it's like a promise to pay taxes later, which is deferred tax liability, a promise to get a tax break later, deferred tax asset. So let's break it down very nicely. As you can see in this diagram, future tax obligation will be your deferred tax liability. Future tax benefit will be your deferred tax asset. Now, as we all know, what are the taxes? The government taxes on our profits, and the government then uses this money to pay for things that help everyone, like schools, roads, and parks. Now, there are two sets of rules which you need to remember. The first rule is accounting rules. These are the actual rules for how much money you really have. Then you've got the tax rules. These are the rules the government uses to figure out how much taxes you owe. As you can see in here, that accounting rules reflect in your financial statements, and the tax rules determine your tax obligations which you have to pay to the government. Now, when we talk about the deferred tax liability, the owe more later situation. So let's say you have a business called ABC Limited. You buy a new machine for the business. Now, choose the best depreciation method for your lemonade stand. Let's suppose that's your business is. Now, you will say 5 years a straight line basis. So you are depreciating the asset over 5 years. So let's suppose you bought the machine for £10,000. You divide it with 5, which is going to be a 2K. So of course your carrying value is going to be £8,000. So 10,000 minus 2 will give you 8,000. But the tax rules say deduct entire cost in 1 year. Now, as you can see, you know that the machine will last for 5 years, as we have just concluded. You spread the cost of the machine over those 5 years, straight line depreciation policy in place. Each year, you say that the machine is worth a little less, which is called depreciation. So, of course, this is the cost of the machine. This is your depreciation. This is your carrying value. So, after 1 year using the machine, it's in your books sitting at 8K. But the tax rules, the government says you can deduct the entire cost of the machine in the first year. This means you pay less tax in the first year. So compare cost reduction methods for tax benefits. As you can see, spread the cost over 5 years, deduct all of it in 1 year. So these are your real rules or accounting rules. These are your tax rules. So what happens? Now in the first year, you pay less tax than you should have if you followed the real rules. This is because the government let you deduct the whole cost of the machine right away, which sometimes, as you must have seen in your previous subjects, called capital allowances. Capital allowances is, once again, a prominent part in TC and BPT exams, professional level. So in this case, they're simply saying that the machine can be deducted right away, all of it. But because you deducted the whole cost of the machine in the first year, you won't be able to deduct anything in the following years. So, as you can see, immediate deduction maximizes the short-term tax benefit, but deferred deduction balances long-term tax liabilities. So what that means in the future, when you're making profits, you will have to pay more tax than you would have if you followed the accounting rules. This is the deferred tax liability. It's like saying I owe the government more in taxes later because I got a tax break earlier. So, immediate tax benefit will result in liability. Future tax liability will increases the future tax payments. All right. So just think about, you borrowed some profits from the government now, but you have to pay it back with a little extra maybe later. Now let's talk about deferred tax asset, the get a break later situation. So let's say you have a bad year in your business, you lose some money. So of course, as you can see, business losses, it created the financial strain in your business. What does the accounting rule say? You can't use this loss to get money back right now. But the tax rules say that the government says you can use this loss to lower your taxes in the future when you make money again or profits again. As you can see, balancing immediate and future losses utilization. So immediate loss utilization accounting rules, but the future losses utilization is according to the tax rules. So what happens? You can't use a loss to get a tax break right now, but you will get a tax break in the future when you make money or when you make profits. This is your deferred tax asset. It's like saying I'm going to get a discount later because I had a bad year now. So when you look at the tax benefits from current losses, immediate tax break, well, not available because you've made losses. But in the future, when you're going to resume making profits again, then you will get a break. Just think again, you have a coupon for a discount on profits in the future because you didn't get enough profits this time. Now, what does that happen? Because the government and businesses sometimes have different goals. Businesses want to show how well they are really doing, while the government wants to collect taxes in a way that's fair and easy to manage. These different goals can create differences that lead to deferred tax. So as you can see, what is the goal of a business? To prepare accurate financial reporting, and the government fair tax collection. So these are the basic differences between these two. Now, is it good or bad? Deferred tax isn't necessarily good or bad. It just means that the timing of when you pay taxes is different from when you really earn the money. That's pretty much it. So future tax increase, deferred tax liability, future tax decrease, deferred tax asset. So choose the appropriate tax strategy based on future tax implications, plan for future tax payments, anticipate any future tax benefits. So what is the important note here? It's important to remember that it's all about the timing of when you pay taxes. It's like a promise to pay or get a break later based on the differences between the real rules or accounting rules and your tax rules. I hope this makes a lot of sense. If you have any questions, please comment below, and I will see you in our next video. Good luck.